Hello and welcome back to Module 1 of the Technical Analysis Masterclass, Price and Trend Analysis. I'm sure many of you have heard the adage, trend is your friend, but it is so much more important than just a saying. When you trade with the prevailing trend in your favour, your entry points don't have to be as precise, and your take-profit targets don't have to be as sharp as they need to be when trading against the trend. This section focuses on the importance of understanding short-term and long-term price trends inside the price chart, and how to determine when these trends have changed. In this lesson, you will learn how to identify short-term trends that form inside price. You'll learn the trading conditions that do not cause a change of trend. You'll learn how to identify long-term trends that form inside of price. And finally, you'll learn how to identify a change of a long-term trend. Let's first look at short-term trends. Short-term trends are trends that form inside the price chart that use the most recent price action to determine their direction. The definition of a short-term uptrend is a sequence of bars that have higher highs and higher lows than the previous bar, as you can see in the example on the screen. Similarly, a definition of a short-term downtrend is a sequence of bars that have lower highs and lower lows than the previous bar. To remove any uncertainty as to whether you are seeing a short-term uptrend or a short-term downtrend in action, you can apply the following rules. Only a bar with a lower high and a lower low reverses a short-term uptrend, and only a bar with a higher low and a higher high reverses a short-term downtrend. These two simple rules will ensure that you know which direction the short-term trend is headed quickly and with a degree of certainty. Now let's have a look at some special change of trend conditions. Whilst it is important to acknowledge price conditions that do indicate changes in trend, it is also important to recognise price conditions that, whilst they may look important, don't actually indicate a change in the price trend. The next type of patterns we'll look at will help determine what price activity is actually just noise and not a leading indicator of changes in price trend. One type of condition that does not meet the condition of a change in price trend is an inside bar. Inside bars don't meet a change of trend condition because the entire price action of the current bar or candle is contained within the range of the previous bar or candle, indicating a pausing of momentum. There are three types of conditions that meet the criteria of an inside bar. Firstly, the entire range of the period fits inside the previous period. Secondly, the high price of the period is equal to the top of the previous period and the low price is higher than the bottom of the previous low. And finally, the low of the period is equal to the low of the previous period and the high is lower than the top of the previous period. Whilst inside bars don't indicate a change in price trend, neither do outside bars. Outside bars don't meet a change of trend condition because the entire price action of the current bar or candle is contained within the range of the previous bar or candle, indicating a pausing of momentum. There are three types of conditions that meet the criteria of an outside bar. Firstly, both the high and the low of the range are greater than the previous period. Secondly, the high of the range is equal to the high of the previous period and the low is lower than the bottom of the previous period. And finally, the low of the period is equal to the low of the previous period and the high is higher than the top of the previous period. Now these six conditions, along with a higher high and a higher low and a lower high and a lower low, cover every possible bar condition, which makes determining the short-term trend an easy to follow process. We have now covered all six conditions that do not indicate a change in price trend and will help you determine price activity that is not so significant. Now we will focus on activities that will help give indications as to the direction of the short-term trend. The final step for determining the direction of the short-term trend involves labeling each change of trend that occurs on the short-term price trend with a P representing a peak and a T representing a trough. To label peaks and troughs, what we do is look back over the historical price activity, identify short-term trends in price and label them accordingly. Short-term uptrends that are reversed are labelled with a P, and short-term downtrends that are reversed are labelled with a T. Now this structure will display a series of peaks and troughs similar to what we see here on the example on the screen. Let's now look at short-term peaks and troughs in action. The example that we can now see on the screen demonstrates how labelling the peaks and the troughs would appear on a real chart. Now as we can see, once labelled, the peaks and the troughs become very clear, and it is easy to determine the direction of the trend. Now let's look at long-term trends. While it is important to assess short-term trends in price activity, it is also important to determine long-term trends. Once the analysis is carried out on the short-term trend, the analysis can then be taken a step further to identify the long-term trend inside the price chart. The same analytical process used earlier to determine the direction of the short-term trend is now applied to determine the direction of the long-term trend. What we are looking to identify is if the peak and trough are both higher than the peak and the trough of the previous period, or conversely, if the peak and the trough are both lower than the previous period's peak and trough. While this may seem confusing, a simple way to remember is by understanding the following steps. If there is a sequence of a trough, a higher peak, and a higher trough, this will define a long-term uptrend. And if there is a sequence of a trough, a lower peak, and a lower trough, this will define a long-term downtrend. This style of analysis makes it easy to identify the direction of the long-term trend in a tricky market where price action is not so obvious. Assessing both long-term and short-term trends will give a better indication of expected price trends as opposed to assessing them in isolation. Although this type of analysis may seem a little confusing at first, once you put it into practice, the logic of how it works will quickly make sense to you. As you can see in the example on the screen, the price trends are a lot easier to see when they are broken down in this manner, and you can quickly determine the direction that the trade should be placed in. Let's now look at long-term trends in action. In theory, trends can be easy to identify, especially when there are lines drawn and evenly spaced, as we can see in the previous examples. The example that we can now see on the screen applies the theory to a real chart to show you how it will look in a trading environment. Now just by looking at this chart, you can see that there is an uptrend. Now trends aren't always this easy to spot, so let's put into action the peaks and troughs method to explain how it can help determine trends. Firstly, you have a trough at the start of the chart, marked with a P. You can then see the price reversal near the top of the peak, which is marked with a P. As you go through the stages of the short-term analysis, the peaks and the troughs begin to form, painting a clear picture of what the trend is doing. You can label higher peaks as a HP and higher troughs as a HT, as this makes it easier to visualize. Once all the peaks and troughs have been labeled, it is easy to draw connector lines that link the troughs and peaks together. And as you can see in the image on the screen, even though you are looking at a real chart, identifying the trend is as easy as it was in a theoretical example earlier. Remember that the market is not always this clear in direction, so it is good practice to label the peaks and troughs for more challenging market conditions. In between all the labelled peaks and troughs, you can see that the only time the trend reversed was when there was a candle with a higher high and a higher low, or a lower high and a lower low. Now let's look at how you would apply the same setup in a long-term downtrend. Again, once all of the peaks and troughs are marked out, it becomes easy to see which of the peaks and troughs are higher or lower than each other. The image we can see on the screen shows a practical example of how the theory works in a long-term downtrend. You can go through and label the peaks that are lower than the previous peak with an LP, representing a lower peak, and you can mark the troughs that are lower than the previous troughs with an LT, representing a lower trough. Once this is completed, it is easy to draw connector lines that link the troughs and peaks together, and as you can see, even though you're looking at a real chart, identifying the downtrend is as easy as it was in the theoretical example earlier. You need to keep in mind that although this downtrend looks obvious, the market isn't always as clear, so it is good practice to apply this method to remove any uncertainty as to which way the trend is headed. Now let's look at long-term trend changes. Once the direction of a long-term trend has been identified, it is just as important to understand when that trend has changed direction. The example that we can see on the left displays a series of higher peaks and higher troughs. A change of trend occurs when price makes a lower peak and then continues down to make a lower trough. Once this sequence happens, the longer-term uptrend has ended, and the sequence that starts a long-term downtrend begins. The example on the screen on the right displays a series of lower peaks and lower troughs, indicating a long-term downtrend. A change of trend occurs when price makes a higher trough and then continues up to make a higher peak. Once this sequence happens, the longer-term price downtrend has ended and the sequence that starts a long-term uptrend begins. Now let's look at a real example of how the long-term uptrend can change. In the image on the screen, you can see that there are a series of higher peaks and higher troughs that are confirming a long-term uptrend. Closer to the end of the chart, there is a situation where price has formed a lower peak. This is the first signal that there may be a potential change of trend. Once price crosses below the previous higher trough, there is a confirmation that the current long-term uptrend has come to an end, and the new sequence of a trough, a lower peak, and now a lower trough confirms that a new long-term downtrend has commenced. The example that we can now see on the screen shows a series of lower peaks and lower troughs that are confirming the market is in a long-term downtrend. Closer to the end of the chart, there is a situation where price has formed a higher trough, and this is the first signal that there may be a potential change of trend. Once price crossed above the previous lower peak, there is confirmation that the current long-term downtrend has come to an end, and the new sequence of a peak, a higher trough, and now a higher peak confirms that the new long-term uptrend has commenced. You have now been able to establish the short-term and long-term trends inside the price chart without using a single external indicator, except for the most important one, the leading indicator known as price action. This process works in any time frame exactly the same way, but remember that the larger the time frame, the more significant the trend. In this lesson, we have learned how to identify short-term trends inside the price chart and when these trends have changed. We've talked about the trading conditions that do not cause a change of trend. We learned how to identify long-term trends that form inside of price. And finally, we learned how to identify a change of a long-term trend without using external indicators. This concludes section 2 of price and trend analysis. In the next section, we will look at multi-time frame chart analysis and explore how it can give you a broader view of the market conditions. We will look at some of the ways that we can analyze larger time frame candles by breaking them down into smaller time frames to help give a real insight to the buyers and sellers within each period.